Well, William Lee is the chief economist at the American think tank, the Milken Institute, and he's with us live from Henderson, Nevada. Well, I want to say another day, another American downgrade. First, it was the sovereign debt rating. Now the ratings of 10 U.S. banks. Help us understand, where is this headed, and what does this say about the overall stability of the banking sector?
Oh, the overall banking sector actually is very safe because most of the banking assets are in the larger banks like JP Morgan, Citi, Bank of America, and those are very safe because they've been stress tested always, and they've been proven to be sound. The Moody is asking the question, will the U.S. need 4,000 banks? And maybe 5 or 10 years from now, we'll only have 2,000 banks because many of them are no longer useful as financial institutions as people start to change the way that they bank.
But at the same time, the ordinary consumer is looking at this and likely feeling nervous. Even Janet Yellen, the Treasury Secretary, seemed to be disappointed by some of these moves. And she said so when Fitch first made this announcement. In fact, we've seen the Biden White House trying to reassure that this is really poor timing. What do you make of this sort of effort by the White House to reassure the public that the economy is strong, that the spending is under control, that all of this was unnecessary?
Well, unfortunately, when the market hears Bidenomics, they hear this phrase, we're going to spend from the bottom up and from the middle out. But they hear the word spend. And that's what Fitch is warning us about, which is the U.S. has been on a non-sustainable spending spree for way too long. Every Federal Reserve chairman from Paul Volcker onward has said the U.S. long-term fiscal trajectory is not sustainable. We're spending way too much. And that is really why the markets right now are in a tizzy, and they're asking themselves, can the U.S. really control its spending? And if not, what do we have to do? And they're starting to raise long-term interest rates gradually, but surely.
So would you say then that the sort of financial strength of the markets, of the banking sector, then is possibly being recognized? Is this a bit of a wake-up call or a warning sign?
That's a great question. In fact, it's a wake-up call to a lot of the smaller banks that are depending on interest rates for their living. They're depending upon the spread between deposit rates and lending rates to make money. And right now, that spread is getting awfully tough to work on. And as interest rates rise, what these smaller banks are finding is that their profits are being squeezed. That's why so many banks are merging with each other, because they just can't make it alone. But going forward, the U.S. banking system as a whole is very sound. Specific individual banks may not be viable, and that's what the markets are trying to sort out right now.
So a lot of our viewers might be watching this and starting to get nervous, thinking, if I have money in my bank, should I be pulling it out? What should I be doing right now? Should I be nervous? Because we've certainly seen some of the headlines in other parts of the world where people have been finding themselves not able to access their money. Is that something that Americans could find themselves seeing as well?
Unlike a lot of the banks in other parts of the world, U.S. depositors are protected by the Federal Deposit Insurance Corporation. Every deposit up to $250,000 or $500,000, depending on how you structure it, is protected by the government and guaranteed by the government. So I think those people don't have to be afraid. If you have more than $1 million at one bank in one deposit, you should get nervous. But what are you doing with $1 million in one deposit in one bank? And you should get some financial advice. So I think for the small, every man in the street, we shouldn't worry. But for the super rich and super wealthy, they should start worrying about how they're putting their money into these smaller banks.
All right, William Lee, we're going to leave it there. William Lee from the Milken Institute, thank you for that. We appreciate it.
Thanks for having me.